Moving over to the restaurant business, Spur has delivered a solid set of numbers despite having to deal with a cash-strapped consumer. In the interim period, the group recorded double-digit growth on its top and bottom line. Revenue rose over 15% and headline earnings per share jumped 16.4%. Company CEO Val Nichas joins me as we dig into the factors that boosted growth. Thanks for your time today, Val. Now, I see that trading in the first quarter was stronger than in the second quarter. Was this even with the December trading, or the December trading brought the two periods on par?
Yes, Nati, good afternoon. It was an interesting pattern to observe. Yes, the first quarter being obviously with a bumper July and continued well, or the first half. And then we started seeing a slight decline in footfall in October, November, and I think it was threefold. I think definitely the continuation of a strained consumer and household spend. I think the added disadvantage was, whilst we all enjoyed being sponsors of the Springbok players and watching the Rugby World Cup, I think there was a lot of clutter on the media. There were a lot of games on a Saturday and Sunday, so we definitely saw more people gravitating to their homes to probably have their drink and watch the game.
And braai.
And then I think load shedding also improved over that period. So I think it was threefold, perhaps even some people waiting for the December spend, which you saw in previous years too, if you saw that graph that we showed today.
Yeah.
And then it turned. In December, we had a bumper December last year, and we managed to beat the numbers on previous year, coming off a high base. So we think trade will continue to be erratic like this, especially going forward. But no, we were very pleased with the final results for the reporting period.
I mean, you talk about this constrained consumer. Have you seen shifts in appetite for your different restaurants based on price points?
We haven't seen any shift in average spend. Our average spend is still growing, and it's growing sort of on menu inflation. We are probably seeing a shift on consumer choices.
Okay.
So I think people are looking for value for their money spent. So I think they are choosing the plate options or the meal options that give them good value. So a good portion of chips, a good portion of onion rings, and a great piece of protein. Or in some of the brands, they're looking at the shareables. You know, a bigger pizza, we can all share a platter, a seafood platter. Even our Rockamama's these days is promoting a big platter of little ribs and wings and chili bombers and chips and things. So I think consumers are just being wiser with where they shop and how they choose their meal solution, just to get a return on that spend.
Yeah, and I see companies have had to be responsive there in terms of innovation on value. Let's talk about some of the challenges, the headwinds that you are seeing there. I see that there are restaurants that are dealing with clean water supply challenges. How much of a risk is that for the business?
Unati, it varies in different regions and different towns, but we all know obviously there are some challenges countrywide, and it's best for us to prepare for this potential risk that could increase. So our franchisees have almost doubled in the number that have invested in JoJo tanks to hold reserve water. The challenge remains a lot of the malls that can't house a JoJo tank anywhere. So if you're trading in a shopping mall, or you're trading in the constraints of a certain sort of footprint, you can't just put up a tank because it needs space, it needs the piping, etc. So I think our franchisees are committed to trying where they can to have additional resources, but I think it's going to be a lot tougher than installing a generator or alternative power.
Yeah, and those additional resources are costly as well. I mean, just looking at that, what you're dealing with now, the costs of, securing clean water supply, but also, secure and consistent electricity. Has that structurally changed the cost profile of the stores?
Yes, the alternative power options, we know now our network is fully powered. There's probably 11 stores that aren't because of the way they're structured. And we know that it is adding pressure to franchisees' operating costs, simply because the overuse of generators means more repairs. It might even mean replacement. And we're having to build those increased operating costs into the business model in order to protect our franchisees' margin and return on investment.
Yeah. I mean, with all these cost pressures, I mean, including also the increase of the minimum wage that is coming into effect tomorrow, are there any low-hanging fruits that you are looking at to increase cost efficiencies?
We're constantly looking at value engineering. We obviously support for employees to be paid well. We think it's good for the economy. It's good for our employees, ourselves, as well, our own people. And we're always doing value engineering, especially on the supply chain, looking at how we can procure products at a better pricing, so that we can start bringing in an improved product at a good margin, so that the menu decisions are a lot easier, because we can't pass everything along to the consumer. So a lot happening around the supply chain. There's quite a lot of work happening around automation of equipment. So looking at shifting some equipment to gas, looking at efficiency so that you're using oil more productively, that you're using your gas a lot more efficiently. So a lot around those areas.
All right. Just as we wrap up the conversation, Val, in terms of a capital expenditure and allocation, what are the focus points, and how much of that is focused on expansionary moves?
We now recently concluded the Doppio deal, which was effective 1 December. So obviously we had invested some of our cash there. In the prior year, we also did some share buybacks. So for the future, we will be considering a few possible options, some of them around development and expansion, perhaps some more share buybacks, but we definitely still very keen to ensure that wherever we have additional cash, it is wisely invested to provide the return on cash allocation.
All right. Well, thank you so much for helping us chew into those numbers, Val. Really appreciate it. That was the CEO of Spur, Val Nichas.